Now we're going to turn to the U.S. And one of the things that before we go into what happened with the GDP number, what does that mean for coming into Q1? We want to start off with the debt ceiling. So we've technically hit it. They'll do stuff to keep the government open, pay bills, delay things, but we've hit the debt ceiling at this point in time, with some extraordinary events that have been taking place. They're going back and forth on ways to get rid of it, ways to do different things. But again, it's important to look at the U.S. government budget breakdown. And I think this was a good understanding of where a lot of these different costs come into when you look at health insurance, Social Security, defense, and economic security programs. You get an idea of just how much of that pie goes into those key areas. So it's going to be difficult because those are obviously all hot button items of trying to find a way, because the issue that we have, and we've alluded to and talked about with charts, as the rates continue to go up, rates continue to move in to a higher degree, we have to roll our debt, and we're going to roll debt at higher rates, issue new debt at higher rates, and that's obviously going to increase the interest expense that the U.S. has to pay, which will then increase our deficit, cause us to issue more debt to cover the higher interest payments. Again, you can kind of see how this debt spiral really starts to spin unless we start to get more and more focused on, because when you look at interest on debt is 7%, just based on the last year, but where is that going to go this year and beyond as we continue to see rates going up? Because we were used to living in this low rate, high liquidity market. So now when you have that in the back of your head in terms of government spending, government input, that can continue to come down. Now the next piece comes into the real GDP growth. So when we look at where things are on the economy capped 2022, when you look at it quarter over quarter, it was up 2.9%. Year over year, it was up 1%. But a big chunk of that was inventory boost. And remember, we were talking about how you can get a lot of lumpiness because of inventory, and that was 1.5%. That is a big number when you're, considering where things are at this point in time, where then when you look at real GDP versus pre-COVID, where the trend is at negative 1.5%. So when you take out the inventory and the government side, things weren't as good as expected, which is why when you look at where things are, and again, I'm not saying that, like some of these other guys like Krugman and some of these other economists, they're like, well, if you take out these 7 things, inflation was actually low. It's like, well, I'm not saying to take them out. I'm just saying that those are lumpy pieces that won't always be there. So it's important to look at it in the context of what is going to drive us in Q1 of this year. And then when you look at real GDP for 2022 is at 2.1%, but then the PCE inflation, the headline was 5.5%, core was 4.7%. And that's a very important piece. But the most important nugget of all of this is that the core of the economy was soft at the end of 2022. And this means that a repeat performance is unlikely, only on top of inventory, that nugget coming down, government spending, slowing a little bit further, is this core, the core of the economy continues to struggle. And that's just looked at final sales to private domestic purchasers. So if as we know, the US consumer drives 70 to 73% of GDP growth. So what does that mean as the consumer, as we saw in November, in December, how sales came down, you're continuing to see that flow down. That's the problem. That's the issue that we see, because inventory provided a nice uplift, government did, that wanes, and then you essentially are exposed to something that's going to be more problematic as we go through the beginning of the year. So then personal consumption component came in at 2.1% versus the estimate of 2.9, and it was a prior of 2.3%. So again, it's the roll. It's not all at once. It's something that it starts to crest and then it accelerates to the downside, with the truth in the GDP report rested in the stagnation in real private final sales, which followed an almost equally small 1% annualized reading in Q3. So again, remember Q3 into Q4, we thought it was going to get worse. We had a decent number in October, which we thought was going to start in October, but instead what we thought was going to start in October started in November and then accelerated as we were expecting in December. And that's where we see that continuation in January and into February when you look at just the activity of the consumer, which is going to really push things down, which is why we've talked so much about the issues, not only in Q1, but then how does Q2 set up? Because Q2 is you're getting into March, that you're pivoting from March into April, into May. You're coming into spring. You're coming into summer spending. People are booking trips for the summer. Where are they going to? And those are going to be important data points of, well, how good is Q2 going to be? How good is Q3 going to be? And are we going to come in a bit light, which we think is likely, given the increase in gasoline prices recently, given the stabilization and creep higher of diesel, which is going to create more problems on the inflation front. So the weak underlying Q4 GDP with inventories and government spending behind 3/4 of it. So when you think about the inventory and government behind 3/4 of it, if that just goes to zero, so just take it out, go to zero. Published during January, and then the data so far is showing where that direction is going to come to. And as we said last year, we had it in Q1, we had it in Q3, again in Q4. You have this lumpiness in inventories, which has to be looked at and understood. And the bond market is seeing through some of that. So here you can see that bond volatility going back to 2012 is still at some of the highest it's ever been. You had the taper tantrum in 2013. Obviously you had the COVID shock in 2020. But we've been hanging out at this elevated level, which is not going to go away. It's going to persist given the underlying problems we're seeing in the market. Another way to measure easing and tightening, financial conditions index has risen or eased back to where it was in February of 2022 when Fed funds rate was at 0%. So again, the market is continuing to shake off what the Fed is doing. They continue to expect a pivot, which is what we've been saying is not going to happen, but it's just a matter of people coming to that realization. As December marked the 10th consecutive month-over-month decline for leading economic indicators from the Conference Board going back to 1960. We've never seen that stretch without the economy already being in a recession. So again, that mixed bag in terms of where we are, more reasons on now the consumer in that underlying piece, even of Q4 GDP, is showing softness. And so far, all of the leading indicators coming into Q1 continue to show that pressure. Assets, the total assets, when you look at the shrinking of the balance sheet, when you look at the breakdown between mortgage-backed securities, you can see that there's been a pause in a lot of this selling, where when you look at Treasury securities, they continue to be a net seller. But you have to put into perspective how far we are elevated in terms of where liquidity is and how much kind of pent-up inflation is in this market because of all of this liquidity. And it's a good start, but again, when you look at what's happening in the market, with especially now that we're at the debt ceiling, are we going to raise it? If we raise it, we just keep issuing debt. But the biggest buyers of that debt have gone away or shrunk, i.e. the Fed. So I always think this is a great chart to put into perspective of M1. When you look at, obviously, you started to see that pivot in 2008, where you had an escalator in terms of the inflation rate, or I should say the liquidity available, and then obviously you had the COVID shock, which pushed us here. So now you've started to roll over, but again, you get an idea of just how elevated it is in regards to where we have been historically. So then when you start looking at the core CPI versus the M3, you have to look at, okay, well, M3, the broad money supply is coming down, but in relation to 2006. But again, where has it been? And what is that multiplier between M1, M2, M3? So yes, it's coming down, but there's so much in the system already that it can come down, and core CPI can still stay elevated. And that's where that disconnect, and we've seen the disconnects before on to the downside, when you look at what happened in 2009. And it's going to be important to look at that core piece, because there's a lot of staying power up there when you look at base metals, when you look at some of these supply chain issues, that is going to keep that a little bit stickier. Not to say that it won't continue to come down. The question is going to be the rate of change it falls. And obviously M3 is going to be a tailwind, a headwind for it. It's going to be an anchor pulling it down, but there's other pieces that roll into that's going to make it a bit stickier. Now, when you start looking at the Fed is typically aggressively cutting rates in a recession, which is, again, looking at that bottom panel, the 6 month change. But so far, if you look at the markets, there's still been an increase. And the increase is because they waited too long to raise rates. And now, because of so much liquidity in the market, they are beholden and we think stuck in terms of raising rates, even as you have a lot of this being challenged. So then when you look at the profit outlook for business continues to weaken. This is the latest from the NABE survey, shows that respondents are quite pessimistic when it comes to profits, with the index now in territory consistent with prior recessions. And again, it's just looking at profit, looking at where your costs are, still a bit elevated, more pressure on the sales side, which again is going to move us down further. Not much changing for yield curves. We're still inverted. So when you look at people that are saying, oh, well, where things are on the inversion side, it's like, well, there's still a lot of pressure on what the bond market is telling you, which is that, you're going to get this snapback. And that's usually when you start to get these moves, as both remain deeply inverted and are hovering near multi-decade lows. Now, when you look at the Fed funds rate, which is obviously moving further up, there's the view that it'll get to about 5%. As you know, we expect it to be between 5 and 5.5%. But look at the average savings account interest rate. And I just, if you didn't laugh, you'd cry, because you're like, oh my God, what is happening right now? And this is an underlying problem. And this is a conversation we've had previously on the show. And my father, I relayed a conversation I had with my father about when the last time he was concerned about inflation and he talks about how his first mortgage was, 21%. He's like, but I was earning 17% in the bank. So when you look at the spread, how much of the spread were you making up? But now when you look at where we are and how low and essentially you're getting nothing for having a savings account. And that's a bigger problem when you look at the spread and the pain in terms of, why are people going to keep money with you? If you're a wealthy individual, are you going to keep your money in savings accounts, or are you going to go invest separately? And then what does that do for the cash on hand for the banks? And again, these are some key pieces when you look at banks lending and how that continues to roll. Now, when you look at the better than expected economic data, does that show some upward revisions to earnings? And again, it's always going to be depending on who. We still see cyclical issues. We still see there was a lot of surges in terms of some of the pricing. Economic surprise index also turning a bit higher. But at the same time, did we also get a little bit of a pendulum swing to the downside where people were too bearish? And now the data that was bearish is still weaker, but not as weak as expected. And again, it's just a matter of that balancing act. But one of the things that we've talked about is we don't see this huge 20% down GDP year. It's going to be this stagnating kind of like slower for longer type situation that we're finding ourselves in, because it's a unique situation. Given where we were from COVID, given where rates were, given where liquidity is, and those are some of the problems that we think are going to persist. And it's showing up in the data with the leading economic index coming in at minus 7.4% versus 6.1% in the prior month, declining increasingly consistent with recession. Strength among components within the leading index has gotten worse, with monthly diffusion index falling back into recessionary territory. So essentially, there's pain across a broader swath of the economy and those leading indicators, which again shows us that we're still headed in that direction. It's just a matter of how bad is it going to be or how deep does it go, which is not, we don't see it going too deep, for too long. I mean, what we see going not as deep, but for longer. So the U.S. leading indicator continues to weaken, is now at that recessionary level, again, pulling that GDP down. The leading economic index from minus 1% in December marked the third consecutive month. So again, just kind of putting it into context with where GDP is. But then when you look at December durable good orders popped higher, they came in up 5.6% versus the estimate of 2.5%. However, the ex-transportation orders were at minus 0.1% versus minus 0.2% estimate. So it's just a mixture of what was driving it. And if you look at kind of the catch up that still needs to happen on the car side, which is happening quickly on transportation in general, but that's why you typically see the new orders on the industry side. It tends to be much higher in terms of where things are. But when we look coming down, that's where we see some of these pressure points, and we don't see that improving in the near term. So the recession and leading indicators, when you look at, again, the Deutsche Bank is showing something similar. Then when you look at what does that lead to? Well, the leading economic indicator leads to an ISM between 40 and 45 months in a 2 to 3 month period, which again is not technically soft landing, but it's just a matter of there's other pieces that fall within that. Then that leading indicator year on year decline doesn't bode well for the forward real GDP, as we've been talking about, with a lot of pressure again to the downside when you look at the initial readings, which is why we see that pressure coming up. And then when you look at the recession signal, the it's implied of a minus 6% year over year, 8.2% 6 month annualized. Most recession signals flashing red, yet GDP was likely in that, and it came in fairly strong. But the rocky start to 2023 it continues, given the retail, manufacturing, and housing conditions that we continue to see. But it's important to look at the equity markets, because households own a large chunk of the equity market. And as we've talked about, we don't see a lot of retail panic. And by not having that retail panic, when do we get that extenuating drop? And we haven't really gotten to that pressure point. So then when you look at the Beige Book Activity Index is showing that slowdown, which is, again, ties back to the leading economic indicators. And it just shows you another data point showing that the real GDP is going to come under pressure as people continue to move about, trying to find better jobs, trying to find better opportunities, which is why you have that net migration, which has gone from high tax regions to low tax regions, and where there's more job opportunities, especially ones where you can work from home or have more of a flexible schedule with a much better cost of living. So then when you look at the labor shortfalls, this is a bigger problem when you look at wages and why wages are going to remain elevated, which is something that we're going to talk more about in the next segment, where wages are going to stay on that sticky side, which is going to drive more of that inflationary talk, more of that stagflation, and that be really a tailwind to some of the costs that we've seen so far. So that's where we're going to end here. In the next segment, we're going to talk and tie this back into where are savings, where are people spending, and how is the consumer setting up as we go into the rest of the year.